welcome to Building My Wealth podcast. I'm doing this live today, apparently again, on LinkedIn via my own LinkedIn profile. Today, I'm continuing our conversation. This is the last part of the 4-part mini-series on how self-employed Canadians buy their first home. You might have heard that as a self-employed person that it's hard to get a mortgage, and I'm here to tell you hard is just different. Part 4 was about the struggles of what some self-employed people go through and the myths around getting a mortgage. Part 2 was more about safe and credible options available to you other than just banks. Part 3 is all about income, and it doesn't matter who you are, mortgages are all about income. And I was alluding to a very important question. What's more important to you, overall savings or getting the lowest interest rate for your mortgage? Today, part 4 of how self-employed Canadians buy their first home, I'm going to make some connections and some recommendations and get you thinking about your own situation. Before I get into that, I'd like to take a moment to introduce myself. I help people find money so you can finance your dreams. Maybe that dream is buying your first home or leveraging equity in your home, make other dreams reality. My name is Juanita Heidebrecht. I'm an Ontario mortgage agent with Bricks Mortgages, a great supporting brokerage. They're actually one of the fastest growing brokerages in Canada. As a brokerage-based mortgage agent, I have access to many lenders, which includes banks, credit unions, financial institutions, alternative lenders, B lenders, and private lenders. I'm also the founder of Building My Wealth website and podcast, a resource of various financial industry professionals and experts dedicated on providing you valuable information on how to build your wealth. I'm also the founder of Wealth Building Divas, a ladies-only professional networking group in Ontario. And if that wasn't enough, I'm also a mom, avid reader, working on becoming an actual published author, crafter, and I love dogs. Today, I want you to really think about this question. It's really important. Okay, so what's more important to you? To keep money in your pocket, when I'm referring to your overall savings, or being able to brag to everyone how you have the lowest mortgage rates available? I bet you're thinking, aren't I saying the same thing? Aren't those two parts of that question synonymous with each other? Well, they're not. I would argue that even if you're salaried, this question is still applicable. The two parts of that question are not the same thing. And it's something for everyone who is self-employed to really think about. Basically, what I'm saying is you can't have your cake and eat it too. The nice thing about being self-employed, you have many ways to bring in the bacon, bring in your income, and also to be able to show your income. In part 3, we talked about various ways you can show your income. It could be a combination of some of the following: showing your business activities in your T1 General, showing your T1 General and your T2 General. There we go. Looking at your accountant prepared financial statements, looking at bank statements and invoices, maybe showing contracts and possible other supporting documents. Banks like it when you have numbers that they can take straight out of your T1 general tax return or your T1 and T2 tax return. Sometimes even then, I found that they still don't understand, and that's okay because we don't have to use them. We have other options. As I discussed in part 2. Some of the options might cost you some money to use, but as I was alluding to previously, that might not be such a bad thing, and I'd like to explain that more shortly. Qualifying for a mortgage is a combination of a few things working together for you. 3 most important pieces is going to be your income, your credit score, and your down payment. We talked at length about income in part 3, and we're going to incorporate that discussion here in this episode. I'm going to quickly touch bases on your credit score, which is really based on your credit history. My advice is always going to be keep working on improving your credit score. Always been working on it. If you don't know roughly what your credit score is, how to check it, or how to improve it, I recommend you register and attend an online webinar on how to improve your credit score. Direct message me for those details and I'll make sure you gain access to that. And it could really help you, especially if you're unsure, you don't know what your score is, or you know what your score is and it keeps plateauing at a certain level and you can't get any higher. It's going to really help you because you know what? Thank goodness it's not a fixed number, because if it was, that would suck. But anyway, because it's not a fixed number, you can always improve upon it, right? Moving forward, I'm going to assume your credit score is 680 and above. A credit score of 680 and above is what you're going to need to not be limited in any which way with your credit score. Don't let a poor credit score hold you back, though. Still keep working on improving it. But many of these alternative lenders will consider borrowers with less than a great credit score. All I'm saying is not all options I'm going to be talking about are going to be available to you because of your lower credit score. Now, for the sake of my examples, and to also keep everything on a level playing field with the examples, I'm going to assume everyone here has a credit score of 680 and above. Okay, for my examples, your down payment is going to be the other most important element to the process to qualify for a mortgage. You may be thinking of looking for your first home, and you feel like, I can save 5%, and you could do that. For a conventional mortgage, you need at least 20% of the purchase price as a down payment. To buy a home, rest of the purchase price is going to be covered by the money that you borrow from the lender, your mortgage. When you provide a down payment of less than 20%, this is called a high ratio mortgage because the lender is lending you more money than they would normally. This is considered riskier for the lender to do so. And in order for them to feel comfortable about lending you more money, getting default mortgage insurance is required. Mortgage default insurance is offered by insurance companies. There are only 3 insurance companies in Canada that offer this type of insurance. They cover the risk to the lender should you fail to not make your mortgage payments and you decide to give up the house. So they make sure the lender gets back what is owed to them. The insurance premium is added onto the balance, increasing what you owe. So you are going to be borrowing more money to be able to put down as little as 5% as a down payment. For the privilege of being able to put 5% down, you have to have a good credit score and be able to qualify mostly based on your tax return. You are self-employed, and not everyone who's self-employed could say that they qualify for a mortgage solely based on their tax return, and you may not want to. Yeah, I said it. You may not want to. This is where the weight of that question I'm asking comes in. And I'm going to repeat it because I feel like it's so important. What is more important to you? Your overall savings, money staying in your wallet, or the lowest interest rate possible for your mortgage? For many self-employed individuals, the answer to that question does not amount to the same thing. I want to tell you a story about a very successful businesswoman. She wanted to refinance her mortgage, and in the process of helping her, she had mentioned that she wished she wouldn't have to bother with T4s anymore for herself. She explained to me that she was paying $3,000 to $4,000 to CRA every year in personal taxes. And the only reason she was paying CRA so much is because she gets her accountant to issue her a large enough T4 every year for the sake of her mortgage. She went on to say that she could be writing off so much more, paying so much less in both her personal and business tax, but she doesn't for the sake of her mortgage. Well, now let's dive into that. I pulled out a piece of paper and started writing down some numbers. At the time, she was thinking about doing a 5-year term mortgage. So in scenario 1 was based on her current situation, which she would be able to qualify for mortgage like any salaried person, because technically she was salaried, right? She would use a prime lender offering her mortgage products that fit her best, and most prime lenders, would have a pretty low interest rate. Over the next 5 years, she would continue to pay CRA $3,000 to $4,000 in her personal taxes alone, and at the end of the 5 years, let's say she, 5-year term, she would be paying roughly $15,000 to $20,000 at the end of that 5 years just to CRA alone. In scenario 2, she would be looking at an alternative lender. There are a number of alternative lenders who really love people who are self-employed. Using an alternative lender, she would be required to pay a lender and broker fee. So let's say that fee would be a combination equaling combined 2%. Now, I'm going to pull some numbers here out of thin air because I don't remember the specifics. And even if I did, I won't even tell you. I do want to use some numbers because I want to help illustrate the potential difference between the amount spent at the end of the 5 years. For the sake of this example, let's say that her current mortgage is $300,000. She wants to refinance to $400,000. Doesn't matter what the reason is. She just needs $100,000 out of her home. With either scenario, she would be paying an appraisal fee and a lawyer fee. With scenario 2, she would be also paying all that plus a lender broker fee. And like I said, for the example, I'm going to say 2%. So 2% of $400,000 is $8,000. She would be paying an additional $8,000 to get a mortgage through an alternative lender. So let's take the conservative amount of $15,000 that she would have paid CRA in scenario 1 minus $8,000 from scenario 2. She would be ahead $7,000 in her pocket, right? Not to mention the savings she would receive by not having to pay more taxes through her business, which I'm going to have to take your word for. Yeah. Anyway, so let's look at another example. Actually, I'm going to pull up a PowerPoint. Let me see if I can share that. There we go. All right. So let's take a look at another example. We have two people who are doing the same self-employed service type work. Pick anything, it doesn't really matter. Maybe they're a plumber, designer, whatever. What matters is that they're both bringing in $200,000 in gross income as self-employed. So person A started roughly 6 months ago, 6 months or a year ago. Person B has been doing it longer, still grossing $200,000 for both of them. Person A is incorporated, okay, incorporated. She also has an accountant who's doing a great job of lowering her taxes whenever possible. She's paying herself in dividends and also saves money by not claiming as much in her personal taxes. Her goal is to save the most money. She sees renting her place as a waste of money and wants to purchase a property as fast as possible. Person B is a sole proprietor. She knows she has to show lots of income to qualify for a mortgage, so she doesn't write off as much as she could. Her goal is to save money by having the lowest interest rate possible. And everyone she's talked to, friends, family, whoever, has said getting the lowest interest rate is going to be the most important thing. So let's say they want to buy a house for $700,000. The minimum down payment person A is going to have to do is 20%. She's also going to be most likely to use an alternative lender, and therefore we need to use 20% based on a marketable house. Now, maybe a bit more depending on the house, available lenders in the area. So, but either way, she's looking at $140,000. Person B wants to put the minimum down as a down payment, 5%, because she wants to get an insured mortgage, which again offers the lowest interest rate. So she wants to put 5% down. So that would be 45,000. Now, the minimum, you would be doing 5% on the first 500,000, 10% on the next 500,000, and then 20% after that. So for her, the first 500,000 is 25,000, and then an additional 10% on the remainder, which is 200,000, and that ends up being 20,000. So 25 plus 20 equals your 45,000. So as a percentage wise, her minimum down payment for a $700,000 house would be 6.43%. Now, based on CRA's tax returns, person A says her income, she pays income on $22,975, while person B doesn't write off as much and pays taxes based on an annual income of $50,300. Remember, she has to do that for 2 years in a row. If all other income is exactly the same, and all their spouse's income and all the other income are exactly the same, that the only difference between the two of them is their own income alone. Hypothetically, person A could qualify for 900,000 and person B could qualify for 750,000 purchase price of the home. Okay. And now, because person A is using an alternative lender, she could technically qualify for more, whereas person B is restricted by the high ratio mortgage parameters. Okay. So they're both buying a house for 700,000, and based on how much money they plan to putting towards the down payment, person A is looking at a mortgage amount of $560,000, whereas person B is looking at a mortgage amount of $655,000. Now, person A needs to use an alternative lender, so she's going to have to pay a lender broker fee of $14,000, and whereas person B can skip that, doesn't have to do that. For the sake of interest rates, I'm going to be using an example here. I'm literally picking out of thin air. I want it to be somewhat reflective of a possible situation, but the most important thing is that one rate is higher than the other rate. Now, I'm using 5.99 for person A, and I'd like to kind of say that some of the factors involved in here for this reasoning is that she's using alternative ways to show her income other than her tax return, and she hasn't been in business as long. But those 6 months, she has been able to show steady income, okay? Whereas self-employed person B is using a lower rate because that was the lowest rate for a high ratio mortgage, because usually high ratio mortgage has the lowest interest rates. Now, person A has the option of qualifying on an amortization of 30 years. She may even be able to qualify based on 35 or 40 years, depending on some lenders. Now, amortization represents the length of time it will take you to pay off the mortgage. Person B has to qualify based on 25 years because you have to qualify based on the parameters of the high ratio mortgage, right? High ratio mortgage requires you to take out a mortgage default insurance. This protects the lender for lending more money than they usually would. And, in the event if you stop paying, the lender makes a claim and the insurance company takes over. Okay, I digress a bit here. Anyway, default insurance, person A doesn't pay, and whereas person B is going to pay $26,200 for default insurance. Default insurance gets tacked on to the mortgage amount. So her mortgage amount is now going to be $681,200 for self-employed person B. Okay. Now, as it stands, person A has a smaller amount that she's going to be borrowing, whereas person B has a larger amount. Let's take a look at what the mortgage payments are going to look like. Person A's mortgage payments, monthly payment based on the interest rate, the amount she's borrowing, is going to be $3,327.51. Whereas person B's monthly mortgage payments is going to be $3,938.66. Now, person A could go shopping right after 6 months, whereas person B is going to have to wait 2 or 3 years because remember, they have to show the income on their tax return. Now, person A is going to be paying less for her monthly mortgage, even though her interest rate is higher. She will have a smaller mortgage amount. Her accountant is going to continue to help her with tax saving strategies. At the end of the day, she's going to retain more money in her pockets. So it's something to consider. So I'm just going to stop sharing. Okay, there we go. Get back to my notes. Okay, there we go. If you are self-employed, the best thing you can do is sit down with your accountant and have a good conversation about your taxes. And then also sit down with your broker-based mortgage agent to come up with some workable strategies on how you're going to be buying your first home. While you're doing that, I'm always going to be saying, working on improving your credit score. Higher is always better, and continuing saving your money. I would even go so far as to saying, speak to a financial planner about maximizing various ways you can save money and grow your money. I hope you found this to be helpful. If anyone is interested in reading more about this, I have an ebook called Unlocking Mortgage Secrets, a mini guide to making smart home financing decisions. Send me a message and I'd be happy to send you a copy. If you would like to hear this again or wish to listen to the previous parts of this 4-part mini-series, you can find it on your favorite podcast listening service like Apple, Spotify, or YouTube, one of the various other ones. The podcast is called Building My Wealth with your host, Juanita Heidebrecht. Thank you for listening. Have a wonderful day.